As we await the start of trade in about 20 minutes, joining us now is Diana Avigdor. She's Vice President, Portfolio Manager, and Head of Trading at Barometer Capital. I think we have 32 S&P 500 companies reporting this week, and the lion's share of those are financials, big weight. They tend to kick things off. What are you looking for from the big banks, Diana?
We have Wells Fargo and JP Morgan, I think, tomorrow. And we also have, out of the 32 S&Ps, some healthcare, Johnson & Johnson. The financials have been flat year to date in the U.S. and have been down year to date in Canada relative to the indices. Net interest margins are expected to be low, and the weight of the earnings expectations lies in the trading revenues, both in terms of fixed income and equities, and those are very volatile metrics. In terms of loan growth, I think JP Morgan, we're expecting 7.3% in average loan growth, with deposits up about 3.9%. So those are some of the metrics that we're watching for. You know, in terms of the financials, it was capital return and them being allowed to return capital to shareholders. That's been the theme, but they've been held back by regulatory regime and compliance, and you know that has kept their costs up. So we're looking for those offsets. In terms of the surprise, which I wouldn't be looking for, is if those trading revenues don't pan out as high as people expect them to, because it really is one of the only metrics that are expected to be really good for this quarter. So I wouldn't want to see that disappoint. Fixed income trading was January, February was $800 billion, which was higher than last year, but then March slowed down a bit. So we're watching for those metrics.
Are there any of the names that you might, I know you own a few of the U.S. banks, is there one that stands out? You said you're not expecting much in the way of surprises, but one that you might want to focus in on? I know Wells Fargo is kind of as much a housing story as anything.
Yeah, we prefer, we have some exposure to the U.S. banks. It is not our biggest weight in terms of sectors. Consumer discretionary, technology, healthcare take a higher precedence over that. But in terms of Wells Fargo, the regionals as a theme appeals to us more than the big banks. It is more a call on the U.S. economy. You see employment is going down. You see housing repairing. Notwithstanding the fact that there's conversations how the economic data has come in a little light, and you know, 2 steps forward, 1 step back. We prefer the regionals that have less of a big bank issue and regulatory issue, and are more growing. For example, Wells Fargo, you know, they're growing their investment banking business. So the regionals are coming into risk, whereas the larger banks are going out of risk. And so that provides some growth.
There's nothing better on Wall Street to look at their own navels, and we have this VIRTU Financial
yes.
Pricing this week. They postponed their IPO last year because of the Flash Boys book, I understand.
Yeah.
What are you looking for? Is it hot? What do people want to see?
You know, it is hot in the sense that management has received lots of requests for meetings, and lots of people call in the conference calls, and some of it, how much is going to translate into actual purchasing? I think the deal will go well, but it looks more popular than it may be, just because people want to know about the market structure, and we finally get a glimpse into the financials of the largest firm that has been pointed at as being an HFT firm. Now, HFT is not always bad. Electronic trading equals HFT. ETF trading, ETF ARB is also electronic high frequency trading. It's not all predatory trading, and so you know, VIRTU is not a predatory trading firm, but it gives us a glimpse into all kinds of places in the marketplace that have been sort of misunderstood before, and I think it will do well.
It's going to be interesting to watch some high-profile guys, including this Vincent Viola. I've just been reading some of the background on him. So that's this week. What about oil, which is actually getting a bid again today? There's some commentary out there, you know, that Iran's going to take 3 to 5 years, that the Iranian deal may be pushed out further than June, and that's giving oil a bid. You're not there yet.
We're not there yet. You know, we watch. We recognize what it has tried to do in the last little while. I do see it still as just a trade. You know, earnings are coming out. Really want to see those earnings. I know the expectations are very negative, and who knows how much of that is priced in. The stocks have moved up ahead of all of this. Inventories are at 80-year highs, so you know, it's all bad news, and it's all predicated on the fact that we've hit the height of bad news. For us, that's not really a reason to go in. There are other sectors that are doing extremely well. Look, consumer discretionary year-to-date is up over 8%. And healthcare, 6.2%, I think. And healthcare is up over 8%. And energy is flat. And financials are actually down about 2%. And consumer discretionary is up about the second year in a row. So we don't want to chase the trade that was last year and trying to pick bottoms. You know, that's not what we do. We need to see a little more. In terms of supplies out of Iran, I think that's the marginal piece of news for sure. It is a bigger picture of major supplies out there. And so we'll see. CFTC data has showing, again, very large number of longs. So people are trying to trade the sector and are moving it up.
We will watch it all. Diana, with you. Thank you very much.
Thank you.
Have a good week. Diana
Thanks,
Avigdor, Vice President, Portfolio Manager, and Head of Trading at Barometer Capital.